I built a $251,000 investment portfolio over my first 4 years of my career, and I'm going to tell you exactly how I did it. When people hear that number, the assumption is that there's some sort of secret strategy behind it. But I am just a normal 26-year-old dude who is not a finance expert by any means. But I understand simple investing strategies and I'm a long-term investor. This portfolio wasn't built through lucky stock picks or timing the market. My investment portfolio was built slowly and consistently over time. So I'm going to walk you through my entire $251,000 portfolio, explain all my holdings, why I have the certain investment accounts that I have, and how I strategize each account. This isn't meant to be a flex at all. This video I'm making is for transparency and education, especially to show people that your average dude can build wealth over time. So the largest portion of my portfolio by far is my 401k, which currently sits at about $183,000. This account is the backbone of my entire investment strategy. There are two good reasons that first come to my head as to why you should invest in your 401k. Those being tax advantages and employer matches. Every paycheck, you can elect for your money to automatically go into this account before you even see it. And most employers will contribute free money into this account, sometimes up to 6 or 7% of your salary. The compounding factor of a 401k is great because with that employer match, they're helping you get past that monumental 100k mark quicker than you would with any other account, which is the turning point of your investments, and that's when you really start seeing compounding interest work for you. But your 401k also offers two types of investment strategies. You get a pre-tax or a Roth 401k. A pre-tax 401k is funded with money before taxes are taken out of your paycheck. That's going to lower your taxable income today. And the main benefit, other than immediate tax savings, is you get faster compounding on a larger invested amount. But you're going to have to pay income taxes later when you withdraw that money in retirement. I have about 50% of this $183,000 401k portfolio in a pre-tax 401k. Now, a Roth 401k, which is the other 50% of this portfolio for me, is funded with after-tax dollars, meaning that you pay taxes now, but your investments grow tax-free, and you have qualified withdrawals in retirement that are not taxed. The only downside to a 401k account is how long you have to wait until you can withdraw the money without incurring tax penalties, and limited investment options compared to, let's say, a traditional brokerage account or a Roth IRA. You can withdraw without adding tax penalties at 59.5. But inside my 401k, I'm invested in just two index funds. 70% of my money is with the S&P 500, and 30% of it is in a growth fund. I'm not trying to pick winners or beat the market here. The goal of this account is long-term growth, simplicity, and reliability. Because this money is meant for retirement decades down the road, I'm comfortable being more heavily exposed to growth compared to most other people's 401k strategies. It's really not bad if you just choose 100% into the S&P 500. I don't check this account daily, and I don't react to any short-term market movements by any means. And this will be an account where I pull out the money to live off of last. The 2026 contribution limit for a 401k is $24,500 for those under 50. Let me know if you're going to max out your 401k next year. The next piece of my portfolio is my HSA, which currently holds about $16,000 and is also offered through my employer. This is by far the best investment tool that I have, and if it's available to you, I would strongly recommend investing in one. The HSA is unique because it offers a triple tax advantage, meaning contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses before and after retirement are also tax-free. However, if I have medical expenses, I'm not going to be using my HSA because you can use your HSA money for qualified medical expenses before retirement. However, if I have medical expenses come up, I'm just going to use the cash in my bank because I want this HSA to keep compounding because of that tax-free growth. HSAs also have an employer match, so that's another great feature of it. HSAs also give you more flexibility to contribute in more ETFs or individual stocks. So my investment split in my HSA is between VU, SCHG, VGT, DGRO, and SCHD. At $16,000 in this account, it's smaller than my 401k, But long term, this account can be extremely valuable because of all the tax benefits I mentioned earlier. This is an extremely efficient account. The 2026 contribution limits for an HSA is $4,400 for those under 55 and not married. Next is my Roth IRA, which currently sits at about $7,200. This is the smallest account right now, but it plays an important role in my overall investment strategy. The Roth IRA gives me tax-free growth and tax-free withdrawals in retirement after age 59 and a half. Having a mix of pre-tax and post-tax accounts allows me to manage taxes more strategically in the future. I can also pull out only my contributions and not the growth from my Roth IRA tax-free if I'm getting closer to the age of 59 and a half and I want maybe an early retirement and need additional income. Last year was the first year where I actually started my Roth IRA and I ended up maxing it out in the same year, which is why this account's at $7,200. In this account, I invest in only 3 ETFs and I keep it very simple: VU, SCHG, and SCHD. I keep this account simple and I love it. The contribution limits for 2026 is $7,500 for those under 50 and has an income limit of $168,000. However, you can always do a backdoor Roth IRA, and if you're curious about that, just give it a quick Google search. My recommendation with this account is to start it as early as possible because that tax-free growth is sweet, and you want time on your side with this account. I plan to max out my Roth IRA for the foreseeable future. The final piece of my portfolio is my taxable brokerage account, which currently holds about $45,000. This is my most flexible account, and it is going to be the account that I can retire early primarily off of. But it is also the least tax efficient account that I have. The advantage here is that the money is accessible before retirement age and can be used for future goals of mine. Because this is a taxable account, I'm mindful of the turnover and tax rates that apply with this. I'm not day trading or constantly buying or selling stocks with this account. The focus is very much still long-term investing, just with more flexibility. This account bridges the gap between now and my traditional retirement accounts if I want to have an early retirement. My investment split in this account is slightly different, but still pretty much the same. I have individual stocks of Meta, and then ETFs of VU, VGT, JEPQ, SCHD, DGRO, and SCHG. My plan over the next year is just to simplify all these positions down to just a few ETFs because I definitely do have some ETF overlap happening, but I'm very much aware of it. I also need to sell out of my positions of JEPQ because I could just move the dollars that I have in JEPQ to SCHD because JEPQ is just more of a short-term income-driven ETF, whereas SCHD is focused more on the long-term investing and dividend growth. DGRO is also a dividend growth-focused ETF, and since I'm aiming for long-term growth, JEPQ just doesn't really have a fit right now in my portfolio. It is just kind of eye candy to me with that high dividend yield, but in my opinion, it's not good. It's not as good of a long-term play as SCHD or DGRO. You'll probably notice looking at this breakdown that majority of my money is tied up in retirement accounts, and that's intentional. Another thing worth mentioning is that this portfolio wasn't built on a massive income right off the gate. I've worked to increase my income over the last 4 years, but this investment portfolio was built through consistent contributions, dollar cost averaging into the market, and sticking to simple and proven ETFs. So the consistency of my investing smooths out all the noise over time. What's kept me motivated is running my different investment accounts through compound interest calculators and just seeing the results. It is fascinating. My goal is to have all these accounts, except maybe my HSA because of the contribution limits, reach over $1 million, and that is totally achievable. Literally, if I didn't invest another dollar, that would still be achievable. I also want to be clear that this portfolio doesn't mean everything in my financial life is perfect. I still have goals I'm working towards. I've had to make lifestyle trade-offs along the way. I'm still renting in the house with my girlfriend because I've been prioritizing investing rather than, saving for a down payment on a house, and that's just a personal preference. The main takeaway from this video isn't the number. It's how I built this portfolio and how everyone watching this video can literally do the same. If all that you wanted to do is invest in the S&P 500 and every one of these accounts that I mentioned in the video, and you did that over, let's say, a 20 or 30 year span, you would be a millionaire. It's just that easy. But it does take patience and time, which not everyone has nowadays. If you're early in your career, the best time to start investing was yesterday, and the second best time to start investing is today. You've probably heard that quote before. The second most important thing I have to say is you got to stay consistent. Compounding rewards the patient long-term investors. Again, I am not a financial advisor, but an engineer with barely 2 brain cells, and I got this thing figured out. So spend some time researching and finding out what portfolio works best for you and just start investing. And this video was meant to be an overall portfolio breakdown across my different investment platforms. And I'm going to do a separate video going over the percentages that I have invested in each of these ETFs. If this breakdown of my portfolio was helpful, let me know in the comments what your portfolio looks like or which account you're focusing on building up right now. And if you want more transparent videos like this around investing, personal finance, or building wealth in your 20s, hit that like button and subscribe to the channel. I'll see you guys in the next one.